Will Zimbabweans experience a good festive season characterized by zig and prices stability, as is the case now? Well, the central bank is pointing to that scenario. Month-on-month inflation has slowed down to 11.7% in November from 37.2% in October. We get more from our business correspondent, Melissa Chatikobo.
The Reserve Bank of Zimbabwe Monetary Policy Committee says there's likely to be stability this festive season. They attribute this to the tight monetary measures put in place to curb inflation.
We currently in an environment of improving stability post September 2024, and we always want to continue supporting that environment. But the best way to drive an economy is to balance growth and stability. Yes, stability is bedding down, but we also want to drive growth. The stability that we are achieving in the economy is being driven by tight monetary policy stance. So the tight monetary policy stance would also need some support of especially the productive sector to drive growth. So we basically balancing growth and stability. Unsurprisingly, the central bank came up with a targeted finance facility. Targeted in the sense that the facility is not expected to go towards consumptive purposes.
According to the recent monetary policy statement, month-on-month inflation slowed down to 11.7% in November from 37.2% in October. The stability in the exchange rate will also continue to benefit from foreign currency inflows, which increased by 19% to $11 billion United States dollars during the 10 months to October 2024, compared to $9 billion United States dollars recorded for the same period in 2023.
The reserves that support the structured currency have continued to increase, and the reserves are now covering the total zig money supply in the economy.
Market watchers say authorities have managed to keep a tight monetary discipline. Inflation is likely to be in control, and the spike in prices anticipated in December may be dampened.
The central bank governor has also come out in the Sunday Mail saying that whatever is happening now, between now and the end of the year, they are not likely to trigger currency depreciation or inflation. So I do not think that we are likely to see price increases. What might happen though is that as people prepare for the next year, especially the payment of school fees, people might want to preserve value.
The year is not yet over. So is there room that other factors may come into play and bring in a new script? Some market watchers are of the opinion that nothing is certain.
We are in the last quarter of the year. Government spending is expected to increase when now they start to do payments to service providers, contractors, by the end of the quarter, payment of bonuses, payment of agri subsidies, importation of food to cushion the vulnerable from the impacts of El Nino induced drought. All this will put fiscal pressure.
Zimbabwe's central bank says it will leave its policy rate unchanged at 35% and maintain tight policy to anchor inflation expectations. Reporting for ZTN Prime, I'm Melissa Chatikobo in Harare.
And now Eben Mabunda joins us live to help us put the latest inflation figures into perspective. Good evening, Eben. Explain to us how month-on-month inflation spiked to 37.2% in October 2024 and put into perspective what has changed since then to account for this decline.
Good evening. In October there, we saw, of course, the monetary authorities stepping in to devalue the ZiG by a good 43%, and the currency has depreciated against the US dollar by about 47% since its introduction in April. But what resulted in that spike there was the fact that we had seen indications of there having been increased money supply on the market owing to payments to contractors who had been instrumental in the rebuilding of the roads, of course, as we had the SADC summit in August. And so the payments to those contractors resulted in increased money supply, which in turn affected the movement where the currency is concerned. And of course, that deceleration there owing to that devaluation, which was in tandem with movements that we've seen on the parallel market, and because that sort of spoke to some of the trends that we saw on the market, that brought some degree of stability. And there are indications that we have not seen any increased liquidity in the market since that particular point, perhaps indications that the central bank may have been playing in the market to suck out excess liquidity during that particular point right up to this point.
So how does the MPC plan to balance tight liquidity conditions with the need to support economic growth and the productive sector?
Well, that's quite a conundrum, given the fact that there would be need for the economy to recover in 2025 as well as beyond. But to speak to what the central bank is looking to use, of course, interest rates have been maintained at 35%, and that sort of makes sense given the fact that we've seen a deceleration in terms of the exchange rate depreciation against the US dollar. At the same time, statutory reserve requirements have been pegged at 15 and 30% for the local, vis-a-vis, of course, the foreign currency deposits where the local banks are concerned. And then the third element would be just how the central bank is alluding to how the 50-50 mechanism was approved by the powers that be, where the payments of QPDs, which are payments to ZIMRA, which are made by formal businesses in the economy, while central bank had indicated an interest where this kind of a measure was concerned, and Treasury had also given that indication, but there was no instrument in place for that to actually take effect. So the fact that there was a gazetting of that particular instrument would give some positive indication. Why is that important? This would somewhat have the effect of strengthening the domestic currency by means of increasing of course the payments in the domestic currency by local companies to ZIMRA. And when that happens, there will be increased demand for the domestic currency and bring or fortify the position of the domestic currency.
And Eben, what is the significance of the recent government legislation requiring corporate tax payments on a 50-50 US dollar to ZiG arrangement?
Well, as I alluded to just now, that this would have the effect of increasing the demand for the domestic currency. Previously, formal businesses were paying their taxes maybe 80% in US dollars, or some of them even 100% in US dollars. The current matrix in terms of formal transactions is 60-40, 60 in US dollars and 40% in the domestic currency. So if that is the matrix that companies are going by, if they then have to pay their taxes 50-50, it means that they would need to source for the domestic currency in order to meet the 50-50 dictates. And in the process, this will result in increased demand for the domestic currency and somewhat reinforce the position of Zimbabwe's new currency, the ZiG. So that's the sort of argument that Treasury has been having, as well as the central bank. And so there are expectations that now that there is that instrument, the gazetting in place, then in the next payment season where taxes are concerned, we could see that having a stabilizing effect where the domestic currency is concerned, holding all factors constant.
Konapo ipapo ba ZTN Prime, DSTV channel 294, the place to be.